what do you do when you're staring at a stock that is just caught in this massive, ugly falling trend,
Right.
like flashing, screaming sell signals on the charts, yet some of the biggest analysts on Wall Street are simultaneously calling it a strong buy with a, 100% upside?
It's a total paradox. I mean, it's the kind of massive contradiction that really makes you question whether the market is entirely rational or if maybe someone somewhere is just missing a gigantic piece of the puzzle.
Yeah, exactly. And that paradox is exactly what we are tearing into today on this deep dive. We're pulling out the microscope on Archer Aviation Inc.
Right. Ticker symbol ACHR.
ACHR, exactly. And as of today, April 14th, 2026, the stock is sitting at exactly $5.55. Now, if you aren't familiar with Archer, they're a major player in the pre-revenue eVTOL space.
Which stands for Electric Vertical Takeoff and Landing. Basically, think air taxis.
Right. It's essentially science fiction attempting to become financial reality.
Yeah, attempting being the key word there.
Definitely.
Yeah.
But our mission today is to figure out if that financial reality actually holds up. We're going to determine if this stock is truly a, severely undervalued disruptor that's going to change urban transit forever, or
if it's just a dangerous value trap.
exactly, just luring in retail investors with a really cool story. And hey, before we get too deep into the weeds, a quick reminder to our YouTube crowd. Go ahead and hit that subscribe button, drop a like on the video, and it is compulsory to leave your feedback in the comments below.
Yeah.
We really want to hear how you are reading this data.
For sure. And just to set the ground rules before we dive into that data, what we're doing here is a natural human debate and analysis of the public sources we have. This is strictly for informational entertainment. It is absolutely not financial advice.
No, not at all. So that brutal chart we mentioned at the top, it isn't just market paranoia, right? It's a direct reflection of a serious battle happening right now.
Oh, absolutely.
Before we even talk about the flying cars, let's look at the actual damage. The current price is $5.55. It's up like a tiny fraction today. You'd be 2.78%, but let's zoom out.
Yeah, you have to look at the macro picture.
The 52-week range is $4.80 on the low end and $14.62 on the high end. It is trading perilously close to the absolute bottom. In fact, the stock is down 38% in just the last 90 days.
I mean, those are incredibly heavy numbers.
Yeah.
When you pull up the technical analysis, the broader trend direction is categorized universally as a strong sell or, very bearish.
Right.
Structurally, it is trading well below its key moving averages. And we shouldn't just gloss over what that means. A moving average isn't just a line on a screen.
No, it's real psychological weight.
Exactly. Think of it as a historical ceiling of priced action. The 50-day simple moving average is sitting at $6.34. And the 200-day is way up at $8.73.
Wow.
Yeah. So every time the stock tries to climb, it hits the weight of all the people who bought at those higher prices, who are just looking to sell and break even. It presses the price down.
Okay, let's unpack this.
Yeah.
Because technically, this chart looks like a skydiver in a free fall whose parachute hasn't opened yet.
That is a terrifying visual, but accurate.
Right. The downward momentum is just brutal. The key support levels are right at $4.80, and then the psychological $5 mark. The resistance on the way back up is heavy between $6.60 and $7.
Yeah, that ceiling is thick.
But with this extreme short-term oversold condition, battling that long-term weakness we just talked about, are retail traders just trying to catch a falling knife here?
What's fascinating here is the conflict in the indicators. Because, we really have to translate this from jargon into actual human behavior.
Right.
The RSI, the Relative Strength Index, is sitting at 49.6 right now, so neutral. But it just recently hit oversold territory back on March 28th.
Okay, and the MACD?
The MACD indicator is actually flashing a minor buy signal right now.
Wait, a buy signal? While it's in a free fall?
Yeah. Because when a stock hits an RSI that low, like Archer did in late March, algorithmic traders get an alert. It essentially tells their systems, the panic selling has mathematically exhausted itself.
Interesting.
The MACD flashing a buy signal just confirms that. It means the downward acceleration is slowing. The sellers are simply running out of shares they want to unload at these basement prices.
So the bears firmly control the macro trend. They own the sky.
Right.
But the bulls are fiercely defending that short-term strength at the $5 concrete floor.
Exactly. It's a turf war.
It totally is.
Yeah.
But look, a stock doesn't drop 38% in 3 months just because of bad chart vibes. To understand why the skydiver is falling in the first place, We have to look past the chart and open up the company's financial books.
And the picture there is, well, it's staggering.
Yeah, it is. Let's look at their fiscal year 2025 income statement. We have to stop and really think about these numbers because they brought in basically a rounding error in total revenue, just like $300,000.
Which for a public company is virtually nothing.
Right. But their net loss for the year was over $618.2 million.
Which breaks down to an earnings per share of negative 99 cents.
Yeah, and the cash flow is where it gets really real. Operating cash flow for 2025 was negative $432.9 million. Free cash flow was negative $376.4 million.
And don't forget the capital expenditures.
Right, another negative $78.8 million. Right now, their quarterly cash burn is a staggering $160–180 million every single quarter.
Yeah.
So, I mean, if they are burning up to $180 million a quarter, how long until that impressive $2 billion safety net on their balance sheet vanishes?
Okay, so let's contextualize that burn rate. Because as a pre-revenue company seeking FAA certification, high capital requirements are the norm, not the exception.
Sure, you're building flying cars. It's not cheap.
Exactly. You're paying for custom carbon fiber, thousands of hours in wind tunnels, advanced lithium-ion batteries, and the salaries of top-tier aerospace engineers.
That's still $180 million a quarter.
It sounds terrifying, I know. But let's look at the balance sheet lifeline. Total assets are $2.46 billion. Liabilities are only $263.1 million.
Okay.
And crucially, like you mentioned, they have roughly $2 billion in pure liquidity, cash and short-term investments.
Right.
So do the math. $2 billion divided by, say, roughly 130 to 150 million on average, or even your high-end 180. That gives them over 15 quarters of runway.
Wow.
That is almost 4 years where they do not need to generate a single dime of revenue to keep operating. In the eVTOL space, having that liquidity isn't just a safety net, it's a massive competitive advantage.
Okay, so we have a company burning massive amounts of cash, but with a huge safety net protecting them.
Right.
Who is actually placing bets on this setup? Because if we follow the money, the insider selling versus the institutional buying is wild.
It is the ultimate tug of war.
Yeah. Over the last 3 months, insiders like the executives and directors have made 10 separate sales, totaling around 355,750 shares.
And the buys?
Zero. Exactly zero insider buys.
Yeah.
None.
But then you flip over to the institutional side, the so-called smart money, and they are holding the line. Heavyweights like BlackRock, Vanguard, and ARK Invest maintain really large positions.
Yeah, and there are even reports of institutional accumulation in early 2025.
Exactly.
But wait, hold on. I have to push back hard here. If the institutional smart money is so confident, why are the company's own insiders selling off their shares?
Yeah.
And doesn't that scream red flag to the retail investor?
I get that. It is incredibly common to view insider selling as a massive red flag, but the reality is a bit more nuanced.
How so?
Insiders can sell for a multitude of reasons. They're paid in stock options, so they sell to cover tax obligations, buy a house, or just, diversify.
Right, they have to pay for groceries eventually.
Exactly. But I will say, combined with the massive spike in short interest, it does show high bearish conviction in the market right now.
Oh, the short interest is crazy. It spiked to 14.35% of the float. That's over 98 million shares currently sold short.
Yep.
And it jumped 12.55% in just a month.
And that creates the perfect powder keg. You have those huge institutional holders like Vanguard and BlackRock holding on to their shares.
Right.
So you have high short interest, but restricted supply. If any good news drops, the shorts panic. They try to buy back shares to cover their bets, but the institutions won't sell.
So the price skyrockets.
Yeah.
A classic short squeeze.
Exactly. It's a fascinating setup.
Which brings us to the ultimate debate of this deep dive. The stark divergence between insiders jumping ship and institutions holding the line. Is this an undervalued disruptor or a value trap?
Well, the analyst consensus is currently a moderate buy.
With an average price target of $11.06, right? Which implies a 100% upside from the current $5.55.
Yeah. The high target is out there at $18 and the low is $4.50. The valuation models are totally split.
Right. Because if you run a conservative discounted cash flow model, the intrinsic value is about $5.54.
Which means it's basically fairly valued right this second. It trades at roughly 2 times book value.
But the future cash flow models point to $28 a share, and that fuels the bull case, the best case recovery scenario. They have a massive order book of over $6 billion,
Yeah, from giants like United Airlines and Korean Air.
plus inclusion in the White House eVTOL pilot program. And here's where it gets really interesting. The huge, tangible catalyst is their partnership for the 2028 LA Olympics air taxi service.
The global PR for that would be insane.
Just imagine athletes bypassing LA traffic in flying cars. It's amazing.
Okay,
But let me play devil's advocate for a second.
go for it.
Why do retail traders often get trapped in stories like this? Isn't it because the story of the Olympics sounds so much cooler than the regulatory reality?
If we connect this to the bigger picture, you're exactly right. The downside risk and volatility are entirely rooted in that reality. This isn't just an aviation stock. It is a binary regulatory play.
Right, the bear case.
Yeah, the worst case continuation lower. You have constant shareholder dilution, massive cash burn, insider selling. But the ultimate risk is FAA certification delays.
Because if the FAA says no, it's over.
Exactly. If the FAA delays certification, that massive order book means absolutely nothing. Airlines won't buy planes. They can't fly legally. And retail gets crushed.
Okay, so we've looked at the technicals, the cash burn, the big money movers, and the opposing arguments. Where does that leave us right now?
Well, short term, meaning days and weeks, we're probably looking at consolidation around the $5 to $5.50 mark. Market sentiment is cooling.
And long term?
Long term is entirely dependent on the race between their cash runway, FAA certification, and hitting that 2028 Olympics launch.
But there's an immediate catalyst coming up, right? The Q1 2026 earnings report on May 11, 2026.
Yes. And this raises an important question. How will the market react to that upcoming report, given the current depressed price? Any hint of FAA progress could spark that short squeeze.
Or any hint of a cash problem could send it through the floor.
Exactly.
So to you listening right now, with all this tension building toward the May 11th earnings, are you going to be tracking the specific daily buy and sell volume to see if institutional accumulation is truly building a wall at that $5 support level? Or do you think the value trap is about to spring?
It's going to be wild to watch.
It really is. Thank you so much for joining us on this deep dive. Just a final quick reminder that this discussion is purely for informational entertainment, not financial advice. Keep your eyes on the data, and we will catch you on the next one.